This is Kyrill Asatur, and this is Centerfin Capital's Collective Weekly for the week ending August 19th, 2024. It was a relatively quiet week. You would expect that for the middle of August, but there were still a number of things that happened this week that we wanted to highlight for everybody. So first, we'll talk about the very large revision to the jobs number that the BLS, the government entity responsible for gauging the strength of the job market, released this week and what that means and how the market reacted. Next, we had the Jackson Hole Central Bank meeting, which happens every year in August. It's much anticipated, and we'll discuss what was said and how the markets react to that. And last but not least, we wanted to discuss a change in the stock market that we observed this week, which is the equal weighted index actually reaching all-time highs, while the S&P 500 actually is still not quite there. Starting with the jobs revisions, on Wednesday it was reported that the BLS overestimated how many jobs were created in the 12-month period that ended in March of 2024. And they overestimated that number by 818,000 jobs, which was a very large number. They had previously estimated about 2.8 million jobs were created, and now we know that it was 818,000 less than that. So about a third of their original estimates of how many jobs were created were basically revised away. Now, that's a very large number. And at the end of the day, the markets didn't really react to that. We think that this was largely priced into the markets, and we'll explain why we say that. The accuracy of the jobs number is hotly debated by those that follow these things. And so the way that the BLS actually provides this number to us every month is they do a survey of, I think it's over 100,000 businesses throughout the country, and they basically ask about hiring and firing. And then they do a lot of adjustments to the survey that they get. And some of it is seasonality adjustments. So for instance, when retailers hire for the holiday season, that's a temporary, obviously, hiring activity. So they adjust for seasonality, which makes sense. And then they have something called the birth-death model, which is highly contested and debated in its viability. And the birth-death model basically says they look historic at how many businesses were created versus how many businesses were shut down. And they basically adjust their survey data for that, for what they think happened in terms of how many businesses were created versus shut down. And the reason that's highly debated and why many people think that it sometimes overinflates numbers is because the birth-death model doesn't do a good job of estimating what actually happens when there's big changes in the marketplace. So effectively, you might be living through an environment where people are less prone to start businesses versus the historical past. And the birth-death model doesn't take that into effect. And long story short, markets didn't really react to this very large revision. It was anticipated. Some had anticipated as much as 1 million jobs to be revised down. But it does tell us that the labor market has not been as hot as we previously were told. And so probably the biggest implication of this is that the Federal Reserve is data dependent, as they've told us many times. And as you all know, the Federal Reserve has recently hiked interest rates to levels we had not seen since before the financial crisis. And they had kept them at this level, basically stating the fact that their dual target, their dual mandate, which is price stability, which is inflation, which has been above their target, and then full employment. And employment has been very strong, while inflation has been coming down, but not quite at their target. And hence their decision has been, let's keep interest rates high until we see both of those things resolving themselves. And it could mean that this overstatement of jobs was really, was bad for how the Fed, the Fed's kind of decision tree when they were making these decisions. But there's nothing that we can do to change that at this point. And we'll take the fact that the bond market and stock market didn't really react to this number to mean that it was largely priced in or expected. And even though big number, markets didn't really react, not much that we can do about it at this point. The next thing that we wanted to discuss is the Jackson Hole speech. The central banks of all the developed countries get together in Jackson Hole every year in August, and they discuss interest rate policy and the economy, their each respective economies. And then usually the chairperson, Jay Powell in today's instance, speaks about what they think their current kind of view of the economy and the interest rate regime that we've been in. And again, a little bit of a nothing burger. He basically said what was expected, which is, look, inflation is going down, which is good, but it's not quite there. And it looks like the labor market is cooling, which we've seen. And it looks like it's pretty good probability that we're going to have to lower interest rates coming up here soon. And nothing really moved on that. The bond yields were down a little bit, but it didn't really, nothing really happened on the back of that announcement. None of the expectations for rate cuts have moved. And so it feels, again, this was as expected as it pertains to markets. We do now expect that the Fed will cut in September. The big question is whether it's 25 basis points or 50 basis points. As we've said before, the magnitude of the cut is less important to the direction of interest rates. And since last December, save for really the first quarter of this year, the direction of interest rates has been clearly down. The Fed told us in December that they were going to look to lower interest rates, and it looks like they're actually going to do it starting in September, which is just next month. And that's good news for the economy. That's good news for anybody that has consumer credit. As you guys know, everything is priced off of the interest rate. But one thing we will note is that the 10-year has actually moved from 4.6-ish at its high this year to 3.8% currently. And so it's actually anticipated these cuts. And what's also important is that all of the consumer credit and corporate credit interest rates are set off the 10-year, not the Fed funds rate. And so mortgages, mortgage rates, consumer credit card rates, corporate borrowing rates are all set off the 10-year. And that's actually come down almost 100 basis points already this year. And it's almost the market has priced in these future cuts, and the consumer should have been benefiting from these lower rates already. We're past this now. This was something the market was anticipating, and it's just another event that we're past. And last, we wanted to highlight what we thought was interesting, which is the equal weighted S&P 500 was made all-time highs this week, which is something that is a change from how the market has acted recently. We've discussed a lot that the S&P 500 index, which everybody quotes and everybody that invests passively is invested in, is heavily weighted towards big tech stocks. And those big tech stocks with their big gains have been driving the market higher, while the overall stock market, which you can measure with an equal weighted index, has actually lagged. And with the equal weighted index actually making all-time highs, while the S&P 500 is actually still 1% or so below all-time highs, that shows us a change in how the market's behaving, which is actually healthy. It shows us that more companies are actually participating in this rally. And it is it's a change in kind of market behavior, and it's something that we take note of. And generally, it should be taken as positive. The contra to that we do want to highlight, as we said before, the 10-year has moved from 4.6 to 3.8 over the course of the last 4 or 5 months. Generally speaking, that is because the market is anticipating rate cuts. Rate cuts usually come when the economy is weakening. And so the stock market making all-time highs while interest rates are coming down are contradictory to each other. It's something to watch and something to be aware of, but we are anticipating, obviously, 75 days or so till the election. There's going to be a lot of news and noise, and probably going to expect some volatility in the markets leading up to that. That's all we had for you guys this week. As always, if you have any questions, comments, please do, and we'll see you next week.